Okay, a few notes before we head into the market outlook for this week. For those of you who are subscribers to the Applied series, on Monday you'll see a new video in sector studies. It was uploaded this weekend. I just got to wait for IT to get in and put it live. It is part 3 of real estate. It's all timber REITs. It's an hour long. So real estate now I think is up to 5.5 hours. 5 REIT types have been covered so far: office, residential, retail, industrial, and now timberland. I'm probably going to add 1 or 2 more before I move on in that module. The sector studies is ongoing. So if you have a subscription to the Applied series, it just keeps going. I'll just keep adding to sector studies as time goes by. So it's going to probably be the biggest module of all of these. For something like applied options, you get to an end. Once you discuss everything, you're pretty much at the end. It's not as if it continues on. With sector studies, it does. Next, I'm moving to the applied macro and top-down analysis. And in here, a big part of that is intermarket analysis, which is a big part of technical analysis. Also, a fairly large discussion of volatility and volatility specifically in the bond market and how that affects volatility in other markets and how we can choose levels based on levels of volatility. That's also very technical as well. So I have to borrow a lot from technical analysis to get that done. So I put a folder up here for technical analysis, and I thought, well, if I'm going to dabble in some of technical analysis for the top-down section, why not add it all? Because technical analysis is at the heart of it very, very applied. So we'll just flip screens here for a second. This is the CMT Level 1 curriculum. There are 3 levels to CMT. This is the Chartered Market Technician exam. If you are a charter holder, by the way, you're granted Level 1 automatically, which means you only have to write the exams for Level 2 and Level 3. If you've been through CFA, you know how big each level is. All 3 levels of CMT is the equivalent of 1 level of CFA in terms of page count. So this is level 1. It has 44 readings. It sounds like a lot, right? But those 44 readings are in 653 pages. Each reading's like 12, 13 pages long. That's it. It comes in 7 sections. So there are 7 sections. I've got 2 of them up already. 2 readings up and another 2 done this weekend. So on Monday there'll be 4 complete readings up, which means 1 whole section is done and 1 section has 4 readings. So there's only 40 to go in 6 sections. I'm going to put everything up for level 1, level 2, and level 3 in the applied series. Which means after you get through the level 1 videos, if you want to write the exam, you're set. You're all ready to write the exam. So the whole curriculum for CMT for level 1, 2, and 3 will be embedded within the applied series, because I was going to borrow about 20 to 25% of level 1, 2, and 3 anyways for the volatility studies and the intermarket analysis. And I thought, well, if I'm going to have 5 readings from this level, 7 from that, 8 from another, why not just do them? And in doing them, again, they're very, very applied. There are a lot of things I agree with and that I use from technical analysis, and there's a lot of things in technical analysis that just are big eye rolls, like, oh, come on now, that's a little too much to swallow. I think I'll pass on that kind of nonsense. And the other part of what I'm doing with this is also showing you how to get this done in Interactive Brokers and on Koifin. So whenever there's a charting feature that has to be used, I'll show you how to set it up in Interactive Brokers if you have Interactive Brokers, or on Koifin if you have that. IB has got a lot of technical indicators, but it's not very good for intermarket analysis at all. So that's why I have Koifin, because if I'm doing intermarket analysis, that's a lot better as well. But there are some features that even Koifin doesn't have, or that Interactive Brokers doesn't have, that are available in other trading platforms. I don't know if there's a single trading platform that has absolutely everything in it in terms of all the charting functionality, because there are some things that like 0.1% of all people would use. Well, maybe there's a feature out there somewhere in some trading platform that has it, but not everyone will have it because you have to make a cost-benefit trade-off. IB says, well, we could program that in for what, 3 people? Why bother? So sometimes you can't get all the features that you want, in which case I'll just show you on the screen how it's done. Yeah, so section 1 is done, 4 readings are done. My goal is to get about 3 to 4 of these readings up a week until they're all done. And I'll be going through 1, 2, and 3. There's 110 readings in total. I'm going to stay true to the book in the first part of the video, and in the later part of the video we'll actually set it up using actual interfaces with Interactive Brokers and Koifin. Okay. One more screen to get through because there has been some issues of I'm trying to put a comment in and it's not going up. Is there a word I'm using? I'll show you the words not to use. Okay, so I've got my word list including just what you see on the screen here, and I'll tell you it has dropped the number of spam comments I get by 75%. I still get some of them coming through. I'm sure some of you still get somebody replying to you, making it look like it's me using my logo, saying, let's get together and chat on Telegram or on WhatsApp or whatever the case is. I will never, ever do that. If I want to talk to you, I'll just talk directly to you. But don't use any variation of the word Bitcoin. Whether you capitalize it, whether you go B.I.T-coin, however you want to write it, no variation of Bitcoin, BTC, BTC, B-TC, anything like that, it'll be blocked. Any salutation, Mrs., Mr., Ms., because these Bitcoin scammers use that. I used expert Miss Sally. Like nobody talks like that in North America. So, right away I know these aren't North American scammers. So no salutations. The word dating, that pretty much got rid of all the porn sites. So don't use the word dating. I tried to find words that it would be difficult for you to use in a normal comment about finance. Telegram is another one, and variations of Telegram like T.E.L or TEL-egram, any variation of Telegram, or the word freedom. Not because people keep crying freedom in terms of their country and that they're looking for freedom. It's just that the Bitcoin scammers keep referring to financial freedom. And I didn't want to stop the word financial, so I thought, who's going to use the word freedom? Let's get rid of that. So don't use any of those words. Okay, let's do this. Okay, another big week for Treasury yields, hitting new highs right across the board, either on October 20th or on October 21st. Also, if you're on treasury.gov looking at data, you'll notice that there is a new data entry for the 4-month Treasury. I'm not going to include it. It is brand new. It only showed up this past week. I don't see the point of it. For what we're doing. It is a money market security. It exists. It's there. You'll see it in the data, but I'm not going to include it until next year. So starting in January, I'll then make a new column for it, and then I'll put it in to see where we go next year. Next year is going to be boring. Next year, this line right here, you're going to see this volatility drop significantly. These are big moves, by the way. I don't want you to get used to the fact that, or the idea that rates move this much. This is super high volatility. 28 basis point moves in a day on a 3-month. 13, 21, 28, 34. Those are really, really big moves. So this is the big switch that's going to happen, I think, once we get past, well, I don't know if it's November or December. November is 10 days away, the November FOMC. And here's the thing. What are they going to signal in terms of what's going to happen in December? I don't expect we're going to get much in the statement, but you have that press conference, and there'll be questions about what December is going to look like. And hopefully, he's not going to say anything. Hopefully, he'll just keep the market guessing. But if it looks like we're getting near the end of the rate hiking cycle, where you have a 75 perhaps in November, a hint at 50 in December, and maybe a 25 in the new year, and then hold, this volatility will drop significantly. As soon as we have visibility on this, we don't have to wait till this day. As soon as we have visibility that this is going on, this volatility is going to drop significantly. I'm sure you have heard rumblings about liquidity drying up in the Treasury market. That's not entirely true. The liquidity that is referred to when we refer to liquidity as something is you look at the bid-ask spread, the difference between bid and ask. And the wider that spread is, the more illiquid we say it is. And I refer to options that way. You want really nice liquid options that are either a couple of pennies apart or at most a nickel apart, maybe a dime apart if you really got to get in there. But when you start getting options that are 50 cents apart on the bid and ask, they're illiquid. You'll see no volume and very, very little open interest on that. Well, imagine you're a market maker. And this is these are moving at 28 basis points a day. Here again, 17 basis points, 9 basis points, 13 basis points, and this has been going on for quite some time. If you're a market maker, you have to post both a bid and an ask to make a market. Well, with this kind of volatility, you're going to widen your bid and ask. So the widening of the bid and ask is a function of the volatility, not the function of the liquidity. The idea that liquidity is drying up in the Treasury market, the U.S. Treasury market, is, borderline. If you were on the border of two countries and this country was called insane, you're borderline insane, I think, by thinking that the largest market in the world is losing liquidity. It's because of volatility. Now, when this volatility drops, it's going to say something for the profitability of selling premium on the S&P, and we'll get to it when we get there. So we can see that rates have increased. We have new rates going into the end of the week last week, Thursday, and at the long end of the curve on Friday, with the rates rising, from the 10-year all the way to the 30. We should have less inversion, and we do. We went from being inverted 48 basis points to now only 28 basis points, but we are 109 days inverted. And look at the inversions you're getting here. Anything with the 3-month is troublesome. Before every recession, the 2s to the 10s has been inverted before every recession. However, not every inversion of the 2 to the 10 has led to a recession. Before every recession, the 3 to the 10 has been inverted. And every inversion of the 3 to the 10 has led to a recession. So this is the number we're looking at now. This has been this way for 109 days. We get it. It's inverted. The big news will be if it becomes uninverted, if we have a bear steepener to the point where we no longer have an inversion. Then we wouldn't have an inversion down here. But this is the slope that I think is going to be more important at this point, is the 3-month to the 10-year. Fed balance sheet ending October 19th is down another 17.36 billion. So we are at 8.213 trillion versus 8.27 trillion. When you look at the top line number, you say, it's like a rounding error, right? 17 billion. T-bills dropped by 3 billion. U.S. Treasuries dropped by 14.8 billion. MBS, I thought they were done with it, but it increased by 500 million. I think that's pretty much it for MBS, but it didn't, the addition of MBS didn't slow down the decrease on the balance sheet, 17.36 billion. Let's look at rates. Last week, for the November meeting, 2% implied probability for 50 basis points. The weight was on 75, 98%. It still is 95%. The fact that it's 5 and 95 instead of 2 and 98, these are just, I think, rounding errors based on, if you had traded for 5 more minutes, maybe it would be different, right? Year end has really changed. 4.25, 4.5, and 4.75. Most of the weight now is on the 4.5. Last week, most of the weight was on the 4.75, 68% for a ending rate at the end of the year at 4.75. It's slipping back down into 4.5. Last week was only 31.3. We're at 51.8. Almost nothing on 4.25, squeaking up to 2.6 here. So it looks like the path for November and December is going to be a 75 followed by a 50, which would get us to 4.5. That's where the weight of the probabilities are now in the market. If we look at 2024, the Fed funds futures through 2024, we hit a low of 95.13 in May, which would put the implied overnight rate at 4.87, which is right between 4.75 and 5, suggesting that we're going to top out at 5%. So we have a 4.5, and then maybe January we have a 25, and maybe February is it the March meeting or the February? One of the next one, the second one, would be another 25, and that would be the maximum. So the market right now is beginning to see the end of the rate hiking cycle. This is the first thing we're hoping for, is the Fed pause. And then the Fed retreat will come much, much later. Based on Fed's funds rate, if you go all the way to December of 2024, we're at 95.355, which implies a rate of 4.645, which is midway between 4.5 and 4.75. So it's peaking at 5% in May, and it looks like we have one cut of 25 basis points by the end of 2024. That is what's being priced in right now. So a rate increase to 5, and then on hold for pretty much all of 2024 with maybe a 25 basis point cut based on the information that we have so far. If CPI keeps coming in hot, well, then we can only go higher from here. If it comes in lower, the Fed has already said they need to see a sustained period of inflation coming down before they even consider dropping rates from a long pause. But they plan to bring it into sufficiently restrictive territory and hold it there for a period of time. The market seems to think, well, you're 4.75 to 5, somewhere in there, ending the year at 4.5 to 4.75. The weight of everything right now seems to be heading towards 4.5 by the end of the year. That's kind of what the market is starting to come to terms with. We're starting to see the end of the rate hiking cycle, which means that we should start to see a bottoming out in equities soon. If not a bottoming out in equities, certainly a big curtailment in equity volatility. Okay, our real rates from the 7-year to the 30-year last week hit new highs, all except for the 5-year. 5-year, we still have September 30th as the high in place. And break-even rates have all increased. And I think that is the market coming to terms with the idea that core inflation is not simply just going to melt away. Now, you might get headline that drops nicely, but it's the core you have to pay attention to, the sticky component. So, inflation went up, and there's a belief, well, it's going to come right back down to 2%. The market's starting to say, no, it's going to be more like that over a longer extended period of time. So the break-even rates are increasing. So when we say the break-even rates, what it means is that if we're going to buy a 10-year bond, we can buy a 10-year TIPS and get a real yield, or we can buy a nominal bond and get a nominal yield. The average level of inflation over those 10 years at which we would be indifferent between the two would be 2.52%. So inflation could be 6% and drop to like 1.5% over that period of time, but it's meant to average 2.52%. We would be indifferent between a TIPS and a nominal bond. If we think the average level of inflation would be less than 2.52, we would prefer the nominal bond. If we think it would be greater than 2.52, we would prefer the real yield bond. We would prefer the TIPS. So that's why they're referred to as break-even rates. It's the level of inflation at which we would break even between a nominal bond and a real bond. Labor market, which is tight and is going to be structurally tight for some time. And I'll talk about that at the very end. When we look at the components of real GDP, one big component, or half the component, is the labor market. It's going to be in structural deficit for quite some time. So there's going to be wage pressure for quite some time. Let's look at initial jobless claims for October 15, 214. We were at, last week we saw 228. It was revised to 226. It was moving towards that magic 275 number, which produces no jobs. I look at the 300 number. If we do 300 a week for 4 weeks in initial jobless claims, you're going to have a negative jobs print. Well, it's going back down from 226 down to 214. So the job market continues to be robust and tight. On Friday, we get PCE out, the PCE price index. We've already seen CPI. Now we get to look at PCE. This is the Fed's preferred measure. We also get within that the employment cost index. The jobs report gives us a measure of wage inflation, which is average hourly earnings. But these two measure wage inflation in two different ways. The jobs report can be misleading. So for the employment cost index, it measures the change in cost independent of the individual, because it can be affected, with jobs report can be affected by the mix of jobs. So as an example, let's say that you have two types of jobs in the economy, one that pays $100 an hour and one that pays $10 an hour. And let's say that they're evenly split between two groups of people. Half the people make 100 and half the people make 10. In fact, let's make it really simple. Let's say that you have one person making 100 and one person making 10. The aggregate, and this is per hour, so the aggregate income per hour in the economy is 110. That is aggregate. The average is 55. And then you can measure the change in aggregate incomes over time and the change in average hourly earnings. Let's say that this person retires and you don't have anybody to replace this person, but this job still exists except it's empty. And this job got a 20% raise and you hired another person here. So now it's making $12 an hour. Well, the jobs report would say that the aggregate income in the economy is now $24 per hour and the average hourly earnings are now $12, which is a significant drop from 55 and the 110 down to 24. You see, it's the mix of jobs that has affected average hourly earnings. That would show a huge drop. Meanwhile, this job pays 20% more. So the people holding this job are more than beating inflation. This job has not disappeared because of any structural change in the economy. Just this person retired and we have no qualified person to take this job, so you have a job opening. Well, the jobs report captures all of that going on at the macro level. What we'd want to know is, for this job that still exists, what does it pay? So that we can measure true wage inflation. Well, that is what the employment cost index does. The jobs report measures what individuals earn. The ECI measures what a job pays. The same job over time. Let's look at some output from Yardini. Okay, this is the ECI, the employment cost index, versus AHE. This is average hourly earnings. You get average hourly earnings monthly with every jobs report, but you only get the ECI quarterly. So let's look at the difference between the two. This is all workers. ECI, private industry, all workers as of the end of Q2 over here, 5.7. Average hourly earnings 6%. So it's coming in lower. And he breaks it down into different categories. Goods producing, ECI versus average hourly earnings. So the average hourly earnings can be affected again by the composition of the type of job. So let's say that there has been a move in the economy towards jobs that are more cognitively intensive, so that the individuals earn more money. But that job that they move up to, they moved from a lower wage job to a higher wage job, while it affects average hourly earnings, you may look at the job they moved into and the pay for that job might not have increased by as much as they increased their earnings by moving to another job. So it's the mix of the jobs in the economy that can affect average hourly earnings. ECI is a better measure of cost inflation for businesses. Look at the significant difference between these, right? 5.4 and 4.7. And you can keep going. There's construction, manufacturing, service providing. This is trade, transportation, and utilities. This is for retail trade. Look at the big difference here, transportation and warehousing. When you look at the ECI index over here versus where the AHE is, right? That's a huge difference between them. So the link is in the description box. I'm not going to go through each one. It is there if you want to, scroll through those charts and have a look. Okay, credit spreads, OAS, all of them contracted, and by quite large percentages here. High yield contracting 6.86%. Double B, top of high yield, contracting 9.2%. Even triple C spreads coming in 3.69%. None of them have hit any new highs. We still have some of the July highs still in place. Oh, sorry, investment grade over here, October 13th is the nearest one that hit a high. So here is your OAS in this column. Here are your yields in this column. It's the OAS plus the appropriate risk-free rate that you would add it to based on how the maturity of the bond. Mortgage rates just crushing, 7.32 with 7.16 last week. Hit a high of 7.37 for the week, pulled back to 7.32 on Friday. For FHA, you're 6.95. You're not that far behind. It was 6.62. Hit a high of 7 and pulled back for the week. Housing market is just being crushed. Nothing new here. No, it's not as if we're suddenly realizing this. We've known this for some time. The National Association of Home Builders, their market index 38. That's a diffusion index. Anything under 50 is contraction. They're at 38. Building permits were up 1.4%. Housing starts down 8.1%. And a lot of this is due, this contraction is due to, yes, you have fewer people looking to buy homes, but you also have fewer spec homes being built. Most home builders are saying with the cost of financing now, we're not going to build spec homes. And a spec home is, I have this development of 130 homes I can develop. I can start building the homes and sell them as I'm building them, or I can build them once I sell them. If you start building and then hope to sell them, that's called a spec home. You're building it on speculation. So spec home building is pretty much gone away because you're not going to finance that. If a buyer buys a home, as the home is being built, there are certain stages. Once the foundation is poured, a certain amount of the price has to be paid. Once the roof is on, another third has to be paid. So as the house is being built, you're getting cash flow in, which reduces the builder's financing costs. So spec houses are pretty much gone. So part of this, when we look at housing starts and we see the drop, part of that is that, well, we're not building spec houses right now. It's not so much that the market has disappeared, it's that inventorying houses has disappeared. Existing home sales down 1.5. Mortgage applications last week, negative 4.5. Both the refis and the purchase indexes are down as well. This week we have the housing price index coming in for August. It's really backwards looking. New home sales being reported for September and pending home sales being reported for September. And on Thursday night, I think it was, or Friday morning, an analyst, housing sector analyst from Raymond James, pretty much downgraded every home builder. So let's read the news release for that. Okay, home builder stock woes deepen as rates hurt affordability. This is cited from Bloomberg on Yahoo Finance, but the source is Bloomberg. In a week where home building stocks were faced with surging U.S. Treasury yields and data showing weakening demand for homes, one analyst is throwing in the towel on the sector. At this stage of the game, at this stage now, this came out just last week. I think it was Thursday night or Friday morning that this was released. To me, it seems like, you're at a boxing match, it's round 7, and you're pointing out to people around you that there's a fight going on. Little late, right? At least I think so. Raymond James analyst Buckhorn downgraded his ratings on all the builders in his coverage, including Lennar and Toll Brothers, citing surging mortgage rates. So 2 points on this. The first one, if you had to pick a porn name, wouldn't this be on your list? Buckhorn? And second, there is one home builder he did not downgrade, and that is DHI, D.R. Horton. And I had mentioned this several months ago that I was not bearish on DHI because it has on its balance sheet a REIT-like asset. It has a whole bunch of homes that it rents. So it is in the home rental business. So as houses come to market that have no buyer, they can simply just rent them. And we know we're in a strong rental market now. Begrudgingly, we are tapping out on the home builders. After a relentless 200 basis point increase in our 30-year mortgage rates over the past 2.5 months. The housing sector and home builders must now brace for a Fed-assured hard landing with significantly lower absorption rates and downward pressure on new home prices. Now, we've heard this for quite some time. We followed the housing sector for quite some time, and it's gone straight down. Yes, this is something that could have been said 3-4 months ago. But to say it now, while we're pretty much at what I would think the depths of it, I don't know that this is going to be much of a call, other than to point out what I think is rather obvious. Home builders have come under relentless pressure this year. Prospective buyers contending with a surge in borrowing costs as the Federal Reserve stays on its aggressive path of interest rate hikes. U.S. economic data this week has also showed housing starts declining, adding to evidence that steep mortgage rates are weakening demand. And again, it might not just be that when we see housing starts decline, as I point out, it might not just be demand. We know that in listening in on the conference calls for the home builders, that they are cutting back or canceling their spec building. So it may also be a drop in supply happening at the same time, not just a drop in demand. Investor sentiment, meanwhile, has declined for the 10th straight month, with the S&P Super Composite Home Building Index having fallen about 37% so far this year. It rose 1.3% this week. And we'll look at some of the real estate sectors in REITs specifically versus their performance against the S&P for the last week. With many home builders sinking to around their book value, Horn expects the group to continue to be challenged if home prices remain under pressure. To be clear, we are fully aware that most of the home building sector is already priced for steep housing recession. Very good. That's an important sentence to make. So he is saying, hey, listen, we are aware that they're already priced here. So it's kind of like saying our downgrade is just catching up with what the market has already done. That said, we need to help investors understand the downside possibilities for EPS in a world of 7% mortgages and unprecedented affordability pressure. In another note, Friday, Barclays analyst Matthew Booley said that the group will continue to be volatile through the earnings season as the low valuations give some support, but without any upside catalyst, as the next rounds of housing data should worsen. And then we do have Pulte Group, Invitation Homes as well, among the bevy of builders expected to report next week. We'll look at earnings shortly as well. Now, on this point, I want to say something. I get the negativity on the home builders, but there's also negativity on residential REITs, saying that rental prices are going to have to come down. Well, those two markets cannot both be correct. You have an argument that affordability is simply out of reach for buying a new home. Well, okay, if we accept the affordability argument, you can't argue for lower rents, because where are they going to go? If you say affordability is going to be coming down over the next little while, so that's why we're negative on rents, then you can't be negative on the home builders. But you cannot be both negative on the apartment REITs or on the residential REITs and negative on the home builders at the same time, because people have to go somewhere. If housing affordability is out of reach for many people and prices on housing have yet to come down, there's no pressure on rents to come down. And if affordability is going to drop precipitously, and prices are going to drop, there's going to be huge demand in housing, well, then you can't be bearish on the home builders. So I hear these two arguments out there, and I think one of you guys are wrong. It might be informative at this point to look at the September monthly housing market trends report from Realtor.com. We haven't looked at this yet. Active listing count, we can see it, topping off over here. This is September 2022. 26.9% year over year increase, but this is pre-pandemic up here around 1.2 to 1.3 million. You're sitting at 732,000, and it's rolling over. You had this upward trajectory here, and now it's rolling over. So, home owners are just saying, well, I'm not going to sell in this market. I'll wait. We can see the same thing here. Total listing count. It looked like it was elevating, and then it's rolling over. Now it's decreasing. So it's only up 0.7% year over year, and this is 2021. Pre-pandemic is up here. So supply is being, with higher rates, you have lower demand, but you're also getting lower supply. Home builders are not going to build spec homes, and homeowners are saying, I can wait before I sell. I don't need to sell right now, and just not listing their homes or taking them off the market. Pending listing counts coming down, negative 23.7% year over year. Newly listed homes, you can see the change in direction here, down 9.8% year over year. Days on the market, still a very brisk market, 7 days longer than last year. Sure, look at where mortgage rates are, right? But selling in 50 days, look at pre-pandemic, you were somewhere between 65 and 70 days. You're at 55 days. Median listing price is coming down, but you can see this curve is starting to flatten out over here. So the prices have come down, still sitting 14% year over year. Even if you have a 10% pullback from here, you would get to where the housing market was in 2021, which was still quite profitable to be in. So you would have to have significant drops in housing prices to get these to a market which is kind of undesirable. So I don't know, with supply coming off the market as fast as demand is coming off the market, I don't know if you're going to get an equilibrium price that feels a need to go much more than 5 or 10% lower nationally. Different markets may have their own particular features, but I don't know that these calls of 20-30% price drops make a lot of sense right now. When you have a housing market in both Canada and the US that are in structural deficit and have been in structural deficit for some time and will be in structural deficit for some time to come, because you have the millennials, which is the largest generation in American history, are in the housing market now, basically entered sometime in the last 5 years, but the big bulk of them will happen over the next 8 to 10 years, and you have markets in structural deficit. I just don't see it. I don't see it. So there we are. Okay, so I have a chart on this side comparing real estate sector, the XLRE. I talked about this last week, that I would be, based on where its dividend yield was, I would be interested in selling some puts on XLRE. 2.67% up for the week. HXB, the home builders, squeaked out, what is that, ITB is up 0.75, XHB 0.49. The XLRE was 2.67. The IYR was up 2.47 for that period of time. And this is a chart of different REIT subsectors, the types of REITs and the weekly change. Here's the S&P 500 down here. Had a weekly increase of 4.74%. The real estate sector, 2.73. I got 2.67 here, so I'm not sure how the 2.73 is being measured. You can see these two REIT subsectors, lodging and data centers, are the ones that beat the S&P 500. This, I think, is a mistake, down 32%, because if we agree with the downgrades in the housing sector, if we agree that affordability is an issue, if we agree the combination of prices that haven't come down enough with mortgage rates that have gone up way too much, that so many people are priced out of the market, well, where are they going to go? They're not going to stop renting just because they can't buy a house. So one of those two things are wrong. So I've been adding to my REIT positions here on almost any weekday. I add shares here and there because I think it's wrong. Another one I think is wrong is industrial. I don't know that this is coming down, and I think it probably has a good decade of good solid growth in front of it. Offices, they've been beaten up quite a bit. I wouldn't touch retail just yet on this one here, and timber is just not ready to go either. Prologis, which is the world's largest industrial REIT, the world's largest, just to give you some idea of their size, they have 1 billion square feet of leasable space. 1 billion. Just think about that. 19 countries, 5,800 customers. They're huge. Logistics centers for either online fulfillment or business to business. Business to business just means Walmart owns a whole bunch of warehouse space, and it's for their own benefit. Online fulfillment would be something like Amazon. 97.7% occupancy on 1 billion square feet in 19 countries, based on their last report. I think they reported on Monday. 97.7% occupancy on that 1 billion globally, on that 1 billion square feet. 76.4% of all the leases that had matured were renewed in that particular quarter. So that means you have 23.6% that didn't renew, but they're still 97.7% occupied. Very little space, and this is very common across all the industrial REITs. Is almost all of them are at 100% capacity. There is no room at the inn. Now, they did lower their 2022 net income guidance, primarily because they said that we're going to pull back on development for now. So in that guidance was that, well, this facility would come online, would buy this one, would expand this way. That's been pulled off. That has changed, but not their core FFO. Their core FFO actually increased because their CapEx spend has decreased. So the core FFO has increased. But when I see something like this, it's not as if it's just US or just Canada. It's 19 countries, 5,800 customers, 1 billion square feet. If you want the pulse of that industry, of that sub-industry, Prologis is the one. These occupancy rates, so I kind of think that, you're down 36.6%. How much further down do you want to go? I think some of these sell-offs are justified, although residential, I do not think so, because you cannot be bearish on residential REITs and be bearish on the housing market at the same time. One of them has to break. Okay, let's look at the S&P 500. The most recent forward 4-quarter EPS is 232.61. Index finished at 37.53.75, so trading at 16.1 times earnings, which is where we are here, sitting at 375. 17 times earnings is 39.54. That is this orange line up here, and I have heard that the 39.50 number being thrown around as upside resistance, that the index could find its way as high as 39.50. It's going to have trouble at 375. It's having trouble right now at 375. There seems to be some reason in the past why 375 is going to be a bit of resistance. If it can punch through 375, its next significant level of resistance is 390. And then by the time you get to 395, you're running into a fundamental level at 17 times earnings. Volatility is still rather elevated at 27.6%. 86.69. The IVP, the percentile, 52-week is 89%. The 26-week is 82, and the 13 is 78. When we get visibility on the end of the rate hiking cycle, so if we see that over the next 90 days that rates are going to do this, and then we're going to be sideways for a while, the day-to-day volatility in yields is going to drop significantly. And when that volatility drops, this volatility is going to drop as well. So the profitability of selling premium right now is going to dry up. It's going to get harder to get those types of ROIs on selling the premium. So November, I think, is probably going to be the last good month I have for selling calls. However, after November, I don't know so much that I'm going to be that eager to sell calls. I think I'll probably switch more to selling puts. In other words, having more puts sold per month than having calls sold. And when you sell puts and you sell calls, here's the thing. You're going to be right on one. Hopefully you're right on both, and the market stays in between where you want it to be. But if you're going to be wrong, you're only going to be wrong on one of them. So that means if you're wrong on the puts, all that call premium helps to lower your break even on the puts. And if you're wrong on the calls, all the put premium you had lowers your break even on the calls, because the stock can't finish both above and below a certain number. It can only be in one place. So if you balance your calls and puts, and you're going to be wrong, well, you get paid really well to be wrong, because you get the premium from the other side of which you were going to be right on. Well, as this starts to drop, then your spreads between your break-evens, that is your strike price minus whatever you got for it, the spreads between your break-evens on balance calls and puts narrows. Well, volatility drops, so it's relative, but the profitability per dollar of margin drops. Just because volatility is lower doesn't mean your margin is lower. Your margin is based on the price, not the volatility. So yeah, I think once we get past November and we start seeing clarity that rates are probably going to top out in the first quarter of 2023, the volatility in rates will start to drop, which will drop volatility everywhere. And if volatility drops, these premiums are going to go away. But at least we won't have these wild rides in markets anymore. And we might find a bottom on the market. So here's what I have in place right now for November. And this will probably be the last aggressive month. The November expiration will probably be the last aggressive month for put and call selling on the S&P. So I have puts in place from 392 down to 380. I've sold some puts for November, and I've sold some calls for November from 340 up to 380. So they match at the 380. My lowest on the puts is 380. My highest on the calls is 380. The average strike price, based on the number that I've sold at the strike price I've sold, my average strike price on puts is 383. My average strike price on calls is 361. When I figure out the effective put price, if all the shares were put to me, in other words, we finished below 380 by November, the November expiration, the average put price would be 359.60. This is my effective put price. That's the strike price, the average strike price minus all the premium. The average premium that I have is 359. For the calls, my average strike is at 361.19. My effective call price would be 374.78 because I'm getting 13.59 for it. If we finish above 392, everything will just be called away from me. Nothing will be put to me. I get all the premium from here and all the premium from here. My break even is 391.28, which is not bad. So if we finish at let's say 392.01, I'll have a short position at 391.28 for everything that gets called away. If we finish below 340, let's say we finish at 339, well, nothing will be called away from me, but everything will be put to me. But the combination of the two premiums would make my average put price 339.97. So 339, finishing below the call price, I would just break even below the lowest call, and I would just break even slightly below the highest put price. I think we're going to have trouble at 39.50. We've been supported at 3,500. Getting to 3,400 or 340 during an earnings season, I think it'd be kind of tough. And since we have a 95% probability of a 75 basis point move by the Fed, them moving 75 is already in the market. So I think I'm good in between these two numbers, and what I'm hoping for here is volatility. That's why I've laddered them this way, is I'm not looking to end at a certain number and make the maximum return. I'm looking for volatility because I'll thin out the herd on both sides. So as the market goes up, I will close puts, and as it comes down, I will close calls. As it goes up, I'll close puts. So I'm hoping the market does something like this. So I'll close some puts here, close some calls, close some puts, close some calls, and I'll thin out the herd. As we get closer to the November expiration, I'll harvest gains where I see them. And then we'll see what happens, as the data starts to unfold into November. But I think it's going to be hard with earnings, unless the guidance is really dismal and earnings beats disappear. Out of the 99 that I've reported so far, it's not that bad. It's not that bad. So I don't know that there's a big catalyst to push down below the 3,500 point we saw on the CPI report release day. If we were going to push lower, that was the day. You remember the video the week before I was saying that was a make or break day for the bottom. And if we look at it on a closing basis, the bottom held. But we seem to be in this small little trading range right now. If we break above it, we'd move to this trading range right here over time. One other thing I forgot to point out before I leave here, notice over here, 373.09, you see this line going across here with the shading. That means I have a short position at 373.09. So that if we do finish 339, the lower we go, well, the better it is for my short position, the worse it is for what's being put to me. But these puts will cover my short position. So my downside break even is actually significantly lower than 339.97. Anything above 392, the higher we go above 392, the worse it becomes for me. However, I do have significant long positions. And if the market is going to break up above 39.50, my long positions would come along with the ride for me. So it would just reduce my upside volatility. Okay, gotta talk about currencies. The BOJ, not the Bank of Japan, the Ministry of Finance in Japan intervened in the currency market again on Friday. That is the second time that it intervened. Started at 10.35. The yen was at 151.61. They finished 11:55 a.m. down at 146.34, and then of course it started to increase after that. Well, it continued on during the day. What you see over here is just this line over here blown up for the morning. So 5.27 yen in 80 minutes. Question is, how much did they spend to get that done, and how many times can they do that? This was the last time they intervened, and this is from the Ministry of Finance. This is from their website in Japan. Total amount of foreign exchange intervention operations for the period August 30th through September 28th is 2.8 billion yen, which is about 20 billion US dollars. Based on the level of FX reserves that they have at the central bank and the amount of USTs they have, they can do that 70 times. They can do that 70 more times. So there's one. They can do this another 69 times. They have the money to get that done. And I say 69 more times, but these USTs are paying coupons. So that actually extends the amount of time that they can do it. So it's not as if they're going to do this a couple of times and be done. They can do this basically every 2 weeks for the next almost 3 years. They can intervene in their currency. So I would be very careful about shorting the yen. I don't know when it's appropriate to buy the yen. I mean, after they finished currency intervention here, if you thought, well, it's stable for a while, I think I'll buy the yen. And it did this, even with the intervention. it never got back to touch your break-even price. So there's still a danger on where you would then begin to buy the yen. But if you think, well, I'll buy a little bit here, and if it keeps going, I'll buy a little bit here, and then a little bit here, and then when you actually see big moves on huge volume, they don't intervene for 10 minutes or 15 minutes. It's usually sustained for a period of an hour, hour and a half. I remember one time when the yen was sitting around 76, they wanted a weaker yen. They did intervene, and they said they would intervene. It was a Thursday night. It was 9 p.m. They said at 9 p.m. on Thursday night, we are going to intervene, which was like, thank you. If you could send me an email 5 minutes before you intervene every time, that would be wonderful. I'll help you out. Anyways, I jumped on board that. This went all the way to 82, and it took about an hour and a half to get that done. So if you are going to be long the yen, dip your toes in a little bit at a time, and when you see big volume and big moves, you know they're intervening. Even if you miss the first 10 minutes of it, that's okay. Jump in big. Really go long and ride it for a while, because again, 80 minutes they intervened, and to move it 5.27 yen in 80 minutes, that is a big move. And they can afford to do that again and again. So, you know, if they spend $20 billion every 2 weeks, they can do that for 3 years before they run out of reserves. Don't know that they would actually do it that often and for that long, but the point is, if you're going to bet against them running out of money, it's going to take you a long time to get that done. The Canadian dollar moved as well during this period of time. It moved 102 pips during this same period of time, from 10.35 to 11.55. It moved 32 pips, and I have 40 futures contracts, which is that's 4 million Canadians, about 3 million US. So that was a $30,000 gain thanks to the Ministry of Finance. So to them, I have to say domo arigato, and keep at it. Don't let the Americans push you around. You just keep at it. You keep doing this. Okay, this week in earnings, what have we got? Excluding the energy sector, the year-over-year earnings estimate for the third quarter here for 2022 Q3 is expected to be down 3.5%. Of the 99 companies that have reported, 74.7 have reported earnings above analyst estimates. Excluding the energy sector, this is for revenue now, the growth estimate is 6.8%. Well, you have, roughly 8% inflation. Revenues are up 6.8% year over year. Kind of underperforming inflation, right? Which is why you probably have the negative 3.5 here. 67.7% of companies have reported revenue above analyst expectations. So that's all kind of in line. The long-term average here is 61.9. We're at 67.7. 20% in, 99 of the 500. During the week of October 24th, 163 companies are expected to report quarterly earnings. The week coming up and next week are the two heaviest weeks for earnings. So this week is going to be dominated by earnings. And two big economic reports, GDP, our first look at third quarter GDP, and the PCE. Those are the two big ones this week. And then next week is earnings and the Fed, and we're all expecting 75 basis points. The announcement isn't going to be a big thing. It's all going to be the press conference, so you're going to want to listen in on that. This is troubling. Normally, after we have 20% of the companies reporting, we would have upward revisions going on because, well, these are better than expected, but we're still heading down. Another week of earnings behind us, and down we go on the Q3 share-weighted earnings, still dropping. 9 of the 11 sectors have experienced downward revisions to estimates. Look at this. The real estate sector has recorded the highest percentage increase in earnings. Here we have, since August 1st, materials and consumer discretionary have recorded the highest percentage decreases, while real estate has recorded the highest percentage increase. And the real estate sector is 95% REITs. Here again, since August 1st, financials and information technology have recorded the highest dollar level decreases in earnings, while the real estate sector has recorded the highest dollar level increase in earnings. Well, what do you make of that, right? This is Q3, Exhibit 2A, Q3 2022 earnings versus expectations, surprise factor 5.4% overall. You have some that are above, some that match, some below, but when you take the average of everything, it's 5.4% above. What do we have? In aggregate, companies are reporting earnings that are 5.4% above estimates, which compares to a long-term average surprise factor of 4.1%, and the average surprise factor over the prior 4 quarters of 7%. So it is lower than the previous 4 quarters. We just started, we're only 20% in. But the average is 4.1, sitting above the average. So far it looks good, right? This is revenue versus expectations. It's coming in 1.4% above expectations. In aggregate, companies are reporting revenues that are 1.4% above estimates, which compares to a long-term average surprise factor of 1.2. So pretty much in line. Over the previous 4 quarters, it was 2.7, but again, we're only 20% in, and a lot of the tech companies and staples and discretionary companies have yet to report. Look at energy here. Growth 2022 Q3, 118%. That's where you get the 3.1. We're expecting that Q3 of 22 will have earnings growth of 3.1% year over year, but you remove energy, as we said up here, negative 3.5%, excluding energy, negative 3.5%. What else have I highlighted here? Here's energy as well in terms of its forecast for Q4. It's forecasting ahead 1 quarter to Q4, which we won't see till January, with energy really leading the pack, 64%. Expecting 4.4% for Q1 23 over Q1 22. And I think we're okay all the way down to the forward 4 quarters, 232.61. The current year, 2022, is 222.14. And the companies that are reporting, here's one I want to show you here. Where are we? This is positive predicted surprises for October 24th through November 4th. Pulte Homes down here, 288 versus 282. Expected to come in a little bit more positive. Here's another interesting one, General Motors, 192 versus 188. Okay, what's reporting this week? I've highlighted what I think are important ones or critical ones that I'm going to pay attention to. So we have General Motors. This is on Tuesday before the bell. How will they do? Pulte for the home builders, and I'm probably going to listen in on their call. For both of these, I'll listen in on their call. Then after the bell, you start to get tech. It's a big week for tech. You have Microsoft followed by Alphabet. The next day, you have some more homes, Invitation Homes. Then you have Facebook, and then Ford at the after the close. Coming down to the next one, Borg Warner. As far as a supplier to the auto industry, they're huge. So it's something, I own shares of Borg Warner, so it's something that I watch. CAT, I think, will be interesting as well to listen to, especially their guidance. MasterCard and Visa report this week, so there's MasterCard. You also get Amazon, Intel, and then we have Weyerhaeuser. Weyerhaeuser is the largest timber REIT in the U.S., and the largest market for timber is home building and home remodeling. So it gives us an idea, and it's highly correlated. The returns for timber are highly correlated with the returns for home builders. So if we get good guidance out of Weyerhaeuser, then, well, that's at odds with what we're hearing about home builders. So it's going to be important to listen to what they have to say, and I'll be listening in on that call as well. Not because I own anything in Weyerhaeuser, it's just because they're the biggest supplier to the housing market in terms of lumber, and lumber makes up like a third of the materials that are, at least the material cost of what's in a house. So you got to pay attention to the ultimate supplier to that, to the home builders. What else have we got? And that would be it on the earnings front. Okay, this I think is an important story. Allstate shares sink after hours on projected Q3 loss. And they attribute their loss to Hurricane Ian, but it's something else that they say, which I think is going to be important on a going forward basis. It ties back to the last CPI report that we looked at, where we saw that insurance was experiencing significant inflation. This gives us an insight into why. So shares of Allstate fell 9% in after-hours trading Wednesday after the company projected it would swing to a loss in the third quarter. Big loss too. Company said it expects a loss of $675 million to $725 million for the quarter. That's not the year, that's the quarter. Compared with last year's net income of $538 million. That's over $1 billion swing the other way. Analysts polled by FactSet were expecting net income to fall to $112 million for the period. Allstate also projected an adjusted loss between $400 and $450 million. Catastrophe losses for the third quarter net of reinsurance. Reinsurance means that Allstate insures a whole bunch of properties for something, and then they say, that's too much exposure. So they go to another company called a reinsurer, and they sell some of their risk to the reinsurer. So that when there is a catastrophe, Allstate pays that out, but then has a claim against the other insurance company that insured it, so they get something back. So this is saying net of reinsurance. Catastrophe losses estimated to be $763 million pre-tax. For September, estimated catastrophe losses are estimated at $440 million pre-tax, of which 80% is related to Hurricane Ian. Property liability premiums written are expected to rise 9.8% to $12 billion due to higher average auto and home insurance premiums and policies. So if we expect more of these types of events to happen, more of these catastrophic events, more fires, more floods, more tornadoes, more hurricanes, you're going to see insurance premiums continue to increase, or you're just not going to be able to get that type of coverage on your property. So that ties back to the CPI report that we saw, where you had insurance inflation. I don't see that's going to abate. I don't see that's actually going to go the other way. So I think that can now be a part of what we would call a sticky inflation. Is we got to say, well, if we have increased risk of catastrophic events, you're going to have insurance inflation, unless insurance companies just throw in the towel and say, we're just not going to insure these types of risks anymore. Well, then that changes the structure of risk for homeowners in certain regions, which could dramatically change the nature of the housing market in those particular regions. Allstate scheduled to report its financial results November 2nd. That's going to be interesting to see. That's the FOMC meeting that day. So if the market is really, really bad, we could probably just blame it on Allstate. Okay, let's look at our economic calendar for the week, and then we'll have a discussion about how the labor market is going to fit into projections on real GDP. I think probably for the next 5 to 10 years. Let's see, anything exciting here? On Monday, 9:45, you have S&P PMIs for manufacturing and services. Not as important as the ISM PMIs, but they just have a different methodology for calculating it, but it just doesn't get the same market reaction as the ISM numbers do. Housing price index on the 25th. Consumer confidence at 10 a.m. Mortgage applications, well, I don't know that there's anything interesting there anymore. Building permits for September, the final look at September. This is the big one here for Canada, is the Bank of Canada interest rate decision, 10 o'clock. And we are fully expecting 75 basis points to 4%. And then it'll be a matter of, well, what's the tone of the press release and what else is said. New home sales at 10 o'clock in the U.S. By the way, even if we get 75 basis points here, the Canadian dollar just doesn't get any respect. So we might have a 17-minute rally on that, and then down we go again. I just have lost all hope that the Canadian is going to say, okay, hey, here we go. I am now hoping that the Japanese intervene more. New home sales at 10 o'clock on Wednesday as well. You have your press conference at 11. So in Canada, if you're interested in that and seeing the effect on the currency, you'll probably see more of an effect during this press conference. Meldrum is hawkish, so he may talk tough, which may support the Canadian dollar for a while. But if the U.S. dollar gets any kind of global bid, that pretty much nullifies any strength the Canadian would have against the U.S. at least. Here's a big number here, GDP. The advanced look Q3 GDP on Thursday at 8:30. That's a big number to look at. That'll be our first look at how real GDP did in the third quarter. The Atlanta Fed, their GDP now I think is at 2.4% for this one. The forecast here is 2.1%. Remember in the second quarter we had negative GDP, but positive GDI. That's gross domestic income. And I've already made a point of this, that they're almost an identity, GDI and GDP, that when they disagree, weight them each by 50 and take an average. We did not have a contraction in the first or second quarter. In fact, we had growth from the first to the second quarter. So real GDP coming more in line with GDI makes a lot of sense. 2.1, that could really be bullish for the market going into the end of the week. So if you have earnings that are coming in as they've come in, a little bit above consensus, the guidance is fairly okay, but not really downbeat. No big exogenous events in the world. You don't have the Fed till next week. Everyone's still expecting 75 basis points. We're in a Fed quiet period, so they can't really talk that up anymore. And you get a nice GDP number. Yeah, if we have trouble at 375, we could bust right through that 375 and maybe find our way up to 390 on this one. And then the next day, PCE. No rest for the weary here. We've already seen CPI. CPI came in hot. PCE coming in hot is going to be no surprise. It is expected to be coming in hotter. Previous was 4.9. Notice this is 5.2. PCE is our cost of living as opposed to our price level. The PCE is lower than the CPI because the PCE does substitute. It does shop around. So if the price of something gets too high, it then substitutes for something else. So the weightings in the basket are different, and it has a lower weighting in the basket for owner's equivalent rent as well. Where is the number we're looking for here? The employment cost index down here, 1.3 previous. There it is, 1.3. It was 1.4, 1.3, expecting it to drop to 1.2. Anything 1.2, 1.1, or 1 is going to be, again, very bullish for the trend in inflation, which means if those numbers come in nice, you could end the week probably at around 39.50. But one of these things go the wrong way. You get a GDP print instead of 2.1 that comes in at like 0.3. Well, things could get ugly fast. And same with the core PCE. If this comes in at like 5.9 and the employment cost index comes in at 1.6 or something like that, something ridiculous, well, then 75 will be back on the table for December, and you might even see 100 show up for November, in which case, yeah, maybe we're going to go back and check out that $3,500 bottom on the SPX to see if it holds. And I don't think earnings are going to save it. Two big bad reports, third quarter GDP and PCE, Thursday and Friday. So the playground is yours till Wednesday. Monday, Tuesday, Wednesday, earnings will dominate, but then two bullies show up. So I'm going to end here with what I think is probably sort of a good framework to think about the markets over the next 12 to 24 months. Everything is GDP driven. every sector really is GDP driven, and if we want higher markets, you have to have higher GDP growth. That's it. And real GDP comes from growth from labor inputs and growth from labor productivity. Growth from labor inputs, as the population grows, you can have a constant participation rate, but if your population grows at a constant participation rate, you have more workers. Or, for a given population, you can increase your participation rate. Well, the U.S. is very anemic population growth right now, and you can always solve that by adding immigration, which in today's political climate, because the U.S., among other countries, but the U.S., I think more so than most other countries, is in the middle of a social civil war, and it is party before country. I don't see the immigration problem being solved anytime soon. The participation rate, I think, is in a structural deficit, not just a cyclical deficit, but a structural deficit, and I don't see that improving over the next little while. Instead of 65% participation rate, you're struggling at around low 62% participation rate. That's a big difference, that extra 3% in the amount of workers that are available. Significant difference. So you have a structural shortage in labor supply right now. As far as the Fed mandate is concerned, employment and price stability, when it looks at employment, that box is checked. And I don't see this improving for quite some time, which means you're going to have wage pressure for quite some time. Hence, down here where I have the path of rates, I expect higher for longer because of this. So we're not going to get much help from labor inputs. It's not going to be enough to really drive GDP growth in the U.S. What about labor productivity? That means more capital per worker. Well, the U.S. already has a lot of capital per worker. I don't think adding more capital is going to be the solution. There's also more capital replacing workers. There is your answer. That is non-monetary. That is a real economy answer to labor inflation or wage inflation, is investments in more capital replacing workers. The problem here is the interest rate works against this sort of thing, because when I have a business and I say, okay, well, I have 100 employees, I should have 150 employees for what I want to get done, but I can't get the other 50. Can I make an investment in some kind of technology that would then replace some of these jobs so that I don't need those extra 50 people, I have something else? Well, I'll figure out how much this stuff costs, what kind of cash flow it can generate, and then I need a net present value on that, which means I need a discount rate, and with the Fed raising rates, that discount rate becomes bigger and bigger and bigger, which makes it harder and harder and harder for any investment to be net present value positive. They end up being net present value negative. Well, the interest rate has to go up to fight inflation. This is where fiscal policy can come in. It can do something there to say, if you're going to invest in labor-saving technology, here's the benefit, the tax benefit you would get. And that tax benefit then adds to the numerator, to the cash flows, that even though you have a higher discount rate because you've added the benefit to the cash flows in the numerator, you can get that investment net present value positive. I don't know. You know, that's what it comes down to, is government has to work, and government hasn't worked for quite some time. But I think that this is going to be your best solution to get rid of services inflation. For goods inflation, as we saw in the last CPI report, came in at 0. Yes, some categories were higher, but some categories were lower in the goods sector. Came in at 0. So you could say, well, you kind of got that box checked. You have some supply issues still hanging around, and you have some structural issues, and your structural issues are primarily in the auto sector. When you have everybody rushing to move to EV, EV has two particular problems. It requires a hell of a lot more chips than ICE, and it requires material that is just in short supply. Not short supply in the earth, but short supply in being available in the market. I've already done a long video on this showing that there's going to be, the industry is going to hit a wall in 2024, 2025, where that's it. You're not going to progress at the pace that you want. And we're already seeing that some of this material for EVs is just increasing in price. When you look at just the price of a battery, the average price of an EV vehicle is, you want to talk about housing becoming unaffordable, EVs are becoming unaffordable as well. That is a structural issue that is going to take some time to fix. There is enough battery material in the world for GM to go all electric. And there is enough for Tesla to continue all electric, and for Ford to continue to switch to all electric, and for Toyota to switch to all electric, but not all at the same time. And that's what they're trying to do right now. You have this massive correlated strategy, and that is creating a structural issue in that particular industry. So I expect price inflation in vehicles to be with us for a while. So wage inflation for a while, this issue for a while, unless some countries say, okay, you know what, 2035 is a little too aggressive, unless some car companies start saying, you know what, if everyone tries for 2035, it'll never get done. You need common sense to come back to the collective. I don't know if you'll get that. Services inflation. Well, this is the problem. The last CPI report showed that we had nothing but services inflation. If you look at core, it all came from services because goods came in at zero. And it is labor supply. That is the big problem, which means your future, or the future, lies here. And the more we can get here, the less work we have to do down here with the rate hikes. And the less work we have to do down here, the lower the cost of capital is going forward, the more desirable this becomes at the same time. So you have a positive feedback loop there. Right now we're in a negative feedback loop, where the higher this goes, the lower the net present value goes, the less we're going to do this, the higher the price goes here, which pushes wages up, which pushes rates up here, which lowers net present value, which means you need more, which means you got to fill these jobs, which pushes wage pressure up, which causes inflation, which you get where I'm going, right? You have that feedback loop going that way. So companies are not stupid. Companies have lots of cash. Companies are going to do something with that cash, and at some level of wage growth pressure, they're going to make those investments in capital that replaces labor. Here's what I think is the path, the most likely path of interest rates. This is all the way up to the end of Q4 2024, and then it just sort of goes this way. There's significant talk that rates are not going back to the zero line anytime soon, barring any falling apart of the economy. That rates aren't gonna, that there's no belief that rates will go back to zero, that probably 2.5 is going to be where rates will end up. We're at 3.25. 5 months from now, we'll be at the end of Q1 2023, sort of thinking that 5% is the rate that we're going to be at. The Fed funds futures market is suggesting stability all year long, with a slight drop going into the end of the year. That's a 9-month holding period at somewhere between, let's call it 4.75 and 5%. And then a slow, and I think it'll be slow, you're going to have to see, inflation, I shouldn't draw it that way, but inflation coming down for a period of time before the Fed says, okay, that's going in the right direction. We've had 6 to 8 months of it doing that now. We feel pretty good. And I think they'll be just as careful to cut as they were to increase. Remember when they first increased, they said, let's just go 25 basis points. I think they'll just be just as careful to cut. And I think they'll go from 4.755 to 2.5 over the period of 12 months, maybe even longer. So Q4 2024, we're still sitting at 2.5, and I think that will continue for a while. Worst case scenario, you get something that starts to look like this, right? In other words, the cost of capital higher for longer, which means even coming out of this, the multiples and the valuation we had going back to 20, 21, 22 times earnings, that PE expansion, I don't see as being realistic on the S&P 500. So it could be till 2020, midway through 2024, 2025 before you even start to think about getting back to the highs that we did see at 4,800. It's going to be quite some time. It's not all going to recover in 2023 and we're done. I think it's going to recover. It takes quite some time to get there because this is a problem. This is not a problem. It won't be any help. I don't think that'll be any help at all. We need this right here. And with this going on here, it lowers the motivation for that to happen. So that is sort of a framework in which I'm thinking about what the next, after we get to the pause level, well, what does the runway look like for the next 12 to 24 months? And I think it looks like that. So you have to start making decisions within that type of framework. And we'll leave it here for the week.